The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone, and welcome to the September edition of Digging into the BI. This is where the people from Maryland, DC, and Virginia get together and look at the latest stocks from the Better Investing magazine. And here are the four stocks we're going to be looking at tonight. It's going to be ePlus, Crown Castle International, Medpace Holdings, and Kinder Morgan. And this is a program that's being sponsored by the Maryland chapter of Better Investing in the DC regional chapter of Better Investing, as we're coming up on almost 3 full years of doing this. So thank you for being here. And let's go to our next slide, Cheryl. So again, here's our standard disclaimer. We're doing these presentations for educational purposes. We believe, like Better Investing, that you should conduct your own review and analysis of any company. If we discuss any securities tonight, and we will, we may hold them in our own personal portfolio or our club portfolios. We'll try to tell you, but again, just sort of be careful. And if we do show you any sites, we're not promoting or endorsing either the websites or the products or services of it. And as you can see down below with that blue underline, this session is being recorded for future use. It will go up on our YouTube page, and we'll talk about that in a coming slide. Next slide, please. So again, most of you are regulars, but in case you're catching this afterwards as a recording to understand who Better Investing is, and you'll see at the top of almost all of the slides the URL for Better Investing, but we're an investment education organization. We focus on long-term investing. You can see those two hyperlinks down below there. And if you're here live, you'll be able to get the handouts, and they will show you the exact link to it. But if you're seeing this as a recording, just go to the betterinvesting.org site and you will find information on us there. And all the people that are presenting today are volunteers. None of us are investment professionals. Next slide. So here's the YouTube channel I mentioned a little bit earlier, is that this is where we put up all the presentations that we've been doing. We're not, if you go to YouTube, you can just type in where I have the arrow going down to the green spot, type in Digging into BI, and you will find it. While you're there, you can sit there, and we ask that if you like the video and share it and subscribe, that helps with YouTube's algorithm. That sort of helps us find it. We're slowly creeping up on this. We have 114 subscribers. Our next goal is to see if we can get over 125. And all of the presentations that are on there are organized in what are called chapters. And what that means is that there'll be a break in the video where you can just advance to the next stock presentation. So if you just wanted to listen to one, you don't have to go through all of them or hunt to where it starts. Though that's what the chapters work for in YouTube. So let's go to our next slide. Again, most of you are regulars. If you have any audio problems, go ahead and take a look. Sometimes it happens when you're on your computer audio, or you're on your computer and you don't have computer audio set. But you can also listen to this on a phone call and to take a look. And also where that green arrow is, that's where the 5 handouts are. That's going to be the 4 completed SSGs for tonight, as well as this slide deck. And inside that slide deck, again, are all the hyperlinks to be able to help you show where everything is. Next slide, please. And so if you want to be able to see this and get a little bit better viewing, you can make that the screen even larger. You can do it where that number 1 is under Zoom. You can just keep making that bigger and bigger so you can see it. And if you wanted to, you can always hit that number 2 with the screenshot to just take a quick picture if you want to be able to remind yourself of something. Those things just are sort of the modern technology way of doing things. Let's go to our next slide. And so why are we doing this webinar? Well, we're trying to be able to show you the resources that are available as a member of Better Investing, and to be able to show you how to be able to use the resources in the magazines to help you find good stock ideas. This is designed sort of focused for beginners, but it can be people uncertain of judgments, although I see in the audience we have a lot of veterans there. But again, it's just a good way to hear other people make presentations on using the stock selection guide of stocks that are sort of circulating a lot in the better investing community. It's a way for the two chapters to work together, the Maryland chapter and the DC regional chapter, and it's a way to be able to promote our club. So if you're in a club in Maryland, DC, or Virginia, give us a shout out. We'd like to be able to have you participate and be part more of the community here, either of the two chapters, because again, we want to be part of the better investing community here in Mid-Atlantic. Next slide. So in just over an hour, we're going to go over 4 presentations. 2 of them, you have the member only stuff. You have to have a BI subscription to it. That's the stock to study and undervalued feature. And then the 2 other stocks can come from anywhere else. We like them to be able to come from better investing sources. And tonight we have one from the roster equality and one that was actually given to us at the annual meeting of the DC chapter. But those are all the different places. It can be from personal experience. And again, just to be in our community and be able to talk about the stocks that seem to fit our approach. Next slide. So here it is. If you want to be able to see this, you can always see what the upcoming stocks are. You don't have to be a member, but if you go to betterinvesting.org and you hit the home about us and the news releases, you'll be able to see it. And again, so these ideas for tonight, Crown Castle International and Kinder Morgan, were announced all the way back in June, and here we are, we're just looking at them right now. But you can see that they already have the October ones up there. In fact, the October issue of BI just came in the mail today for me. Let's go to our next slide. And so if you want to be able to see announcements, here's a way to do it. If you're a member, you go over into where it's My Account in the upper left, where I have the red circle there. And then from there, you want to be able to hit your email and product subscription information. That's the green circle. That will open up the green window over on the far, far right. And there you can be able to take a look at, you can click on where the arrow is for local chapter news. That's where you'll be able to get announcements for this. But before you do that, I sort of like to go where that yellow highlight is. It's a BI weekly newsletter, and that's a member exclusive thing that be able to help show some of the things that are going on in our community and a way to stay connected with everyone no matter where you are. And then you can go down to the bottom and hit that Save Changes. Let's go to our next slide. So here's that member exclusive that I just mentioned. Here's the one that came from just this Thursday. It comes out at the close of business on Thursday. If you have signed up for it and you're not getting it, go ahead and check your spam filter. But there are upcoming events on Stock Up and Ticker Talk. There are usually new first cut reports are listed there, and also some good stock ideas and screening places, as well as different other educational events that are coming along. So keep this in mind and make full use of your BI membership. Next slide, please. We're also up on Facebook. We're a little bit more active over at the Maryland, or at the DC regional chapter. That's the one up on top. But I'll have to admit that I didn't get the announcement up for this until today. But the Maryland chapter also has a spot. It can be shared with BI members, non-BI members, a way to be able to sort of connect with us and to be able to talk things out there. And it's a great way to be able to show what we're doing to prospective members to your club. Next slide, please. And we also have something here that's new. Jonathan, do you want to tell us about the meetup that you're working on over at the Maryland chapter?
Sure. The home office has established at least 9 chapters currently, and established them with meetup pages. And the purpose of the meetup is to introduce better investing to the general population or the community as a whole. And as a member, members have the ability to filter their location where they want to participate in new activities or educational events. So we have actually had people as far as California that were interested in some of our local webinars and events. So I know we have several members who have signed up to Meetup to participate in this current meeting. So this is a wonderful way to introduce better investing to the general population and the general community. So it's working quite nicely for us. Just about every week, someone is signing up and becoming members of our page right now. So it's been a fantastic experience. So something that we will definitely continue in the future.
Very good. And yeah, it's free. You don't have to be a BI member. Do you want to also tell, let's go to that next slide, Cheryl. I was sort of talking over. Do you want to give us a report on how the portfolio contest ended there? And I see we have the portfolio contest winner in the audience tonight.
Okay. So the winner was Bright Ideas, and you can see his portfolio has been absolutely fantastic with a total gain of 23.2%. Second place was this person, Kay Galogly, who knows who he is. But anyway, this was a fantastic way to get people involved in developing a portfolio and seeing how you're doing with your other members. And so we are actually preparing for 2024. So we will be posting that information very soon on our webpage. So stay tuned for the 2024 Stock Pickers Contest. But congratulations to the winner and everyone that had participated. Thanks.
Okay. Next slide. Cheryl, you want to tell us about the book club?
Yeah, this is a monthly book discussion that we have from the DC Regional, except for the month of December. It is offered on the third Tuesday of the month. Starts 7:30, usually runs till about 9 those evenings. The next book is going to be Against the Gods, the remarkable story of risk by Peter Bernstein. And I urge you, you don't have to read the book. Usually the person who is in charge of reading the book for that month puts out some pretty good notes. So if you look at the notes, we send them out in emails. You can usually follow along, or if you are so inclined, you can read the book as well. But it usually has a very good group of people joining, and it's gotten larger since we've been virtual. And you can go to the DC local events, and you will see the link there.
Okay, Cynthia, you want to tell us all about your club?
Now that's the Maryland chapter. Oh, you're right. Go ahead.
Yeah. The Maryland, I'm sorry, yes, my club, investment club, we affectionately say ITBIC. We started in March 2021. We do currently have 8 partners. We meet the second Sunday of the month at 7:30 to 9, and we're strictly online. Currently, our 8 members span 3 states. We have some in North Carolina, others here in Maryland, and we also have in New York. So we just met yesterday evening, so we haven't determined what our next education and our stock study will be for the month of October. But if you're interested in knowing more, seeing more, please reach out to me, and my email is there.
Thank you. Susan, why don't you tell us about your club?
Okay, I am a member, besides being a member of the DC chapter, I'm a member of the Happy Destiny Investment Club. It was started in 2001 with 9 partners, one of which the one founding member remains. We meet the 3rd Friday of every month. We initially met in person, but we have gone to online since the pandemic. It seems to be working for us. We meet from 6:30 to 9:30, from 6:30 to 9 p.m. Our next stock study is the Vita, and our education is to be determined. And if you would like to know more about the club, we currently have about 9 partners. We are always looking for new partners and fresh ideas. You can reach us at diginfo.bi@gmail.com.
Very good. Let's go to our next slide. And this is the Montgomery County Model Investment Club, MCMC. We started in 2017. We got 5 partners. We're picking up one more probably at the beginning of the year, but we meet be a week from Wednesday, and we're going to be looking at for our education. We're all online. There's some new enhancements with the My iClub stock watch list that we're going to do, and then our stock study is going to be WEC and Energy Group. They're out of Wisconsin. There's a picture of us with some of the people from another club, Pinnacle, and we like to do social events as well. So hyperlink is right there. Come and see us. Next slide, please. Cheryl, tell us about your club.
Besides also belonging to the chapter for Northern Virginia, also belong to the McNova, which is the Model Investment Club in Northern Virginia. It was started in 2008, currently have 12 partners. We meet on the second Tuesday of the month, and there is our hyperlink. The meetings start at 7 p.m. and run to about 9 p.m. Visitors are free to join and check us out. The education is going to be the total return versus the upside downside ratio. And the stock study is going to be HICO, which is ticker HEI. And there is our email if anyone wants to send us an email. Check us out.
Cheryl, I just noticed I forgot to, it still lists an August date. You're actually meeting tomorrow, so that will be the 12th. Yes. My bad. Sorry.
Yes, we are. No,
okay.
Fine, thanks.
Next, let's keep moving. Tell us about Visit a Club, Cheryl.
All right. So Visit a Club is promoting clubs that are looking for members. And they give us their information there, and there is for Maryland as well as the DC regional chapter. And you can then check out those clubs and see if they meet your expectations. And also we have a Visit a Club where directors can come out to your club during your club meeting, be it virtual or live meetings. You just have to request director depending on which chapter you're in, and we can hook you up with a director to answer questions or areas of concern within your club members.
And this is something that's new. This is Club Connect. They've just sort of been rolling this out from headquarters, sort of an electronic version of what Cheryl was just talking about as a way to do it. So if you click on that, they'll sort of walk you through it as a way to be able to find people that are near you that are sort of looking for it. And yeah, having someone come on out and show you how a club is to starting out. In fact, I see in the audience tonight that the person who helped us when we first started Happy Destiny in 2001 is in the audience. So shout out to Helen. Helen, I see you there. I hope you're doing well. Thank you very much for all your help over the years. And this is a way to do it going forward. So looking for members, try this. Next slide. So we are digging into the BI, so let's quickly look at the magazine. Again, you can get it either on the app or you can get it through the e-magazine. I've asked a couple times before if anyone reads it on the app, and most people say no, and just wait for it for the paper to come. But there it is. In fact, like I said, I already got my October issue is sitting in here. Sort of got beat up along the way in the mail, so I'll have to flatten it out. But here it is. Let's go to the next slide. Some of the other things that are kind of cool when you do it online is that you see where that red arrow is, where there's analyst reports and other resources. A lot of the documentation that you'd have for stock to study and the undervalued feature are right there. And if you want to use a mobile device, the line just above it where the green arrow is, that's for mobile devices. It's a different username and password than what you'd have for your traditional one. But again, that way you can be able to look at it on a tablet or on your phone, whatever, and just keep those things in mind. Let's go to the next slide. And this is sort of, I thought what Ken Zindel, the CEO of BI. He was pointing out some of the changes. We've talked about some of them already over the last couple months, how they've improved some things with member sentiment and the judgment audit that's there. And they also were talking about how they have an improved way for the club renewal process when you're doing it under the My Account stuff. And he also was pointing out that the membership prices has remained unchanged. So take a look at that. Let's go to our next slide. And what I like to do whenever I see a club that's featured in the magazine that comes from either Maryland, DC, or Virginia, I like to give them a shout out. And here it is. This is a colleagues investment club from Richmond, Virginia. And they started with people from the State Department of Education in 1967. One of the founders still remains. And, the repair shop is a great way to see the people that do it, Dan Boyle and Scott Horsberg. They'll give you a nice good thumbnail on what they think of those particular stocks that are in the portfolio. But the other thing, and I noticed this for the first time, is that CIC, as it's called, they have basically a strategy for investing, and you'll see the hyperlink to it. But if you go back and you look at those same places where I was showing you those resources that are available, they have they're posted up there as well, so you can be able to see. It looks like it's sort of an investment policy statement, but it sort of helps guide them in terms of how they're taking a look at. So go ahead and see if that's something that you would want to do for your club. Next slide, please. And finally, here's some of the stuff that's coming up for every month. If you look on page 51, there's always some good things that are going on. The one in green is South Florida. In fact, I see Sophia's in the audience, so congratulations. It just happened this last Saturday, but they have a regular reoccurring events there. So take a look at that. They're online. They are free on Saturdays, so take a look at it. And then again, later on this week, the Northeast Ohio chapter has a program on challenging boring stock using the stock comparison guide. Again, free. You don't have to go to Ohio or Florida to do it, but that's a way to take a look at it. Let's go to our next slide, and I think we're ready to start talking stocks. So the first two we're going to look at are going to be ePlus and Crown Castle, and they're going to do it in core. And let's give it straight over to Cynthia, and she can tell us about ePlus.
Awesome. Thank you. So my name is Cynthia D. Bonham Williams, Cynthia Williams to be short. I am a volunteer with the Maryland chapter of BI, and you saw earlier I'm a part of an investment club called In the Black. And I'm going to be on a presentation tonight on ePlus Incorporated. Next slide, please. So just to give you a little background about it, ePlus Incorporated is a technology and financing solution provider. They offer a range of IT products and services to businesses and government agencies. Plus is in the software application industry technology sector. It's a medium-sized company with sales between $1 billion to $10 billion. The company is being publicly sold on the NASDAQ under the ticker symbol PLUS, capital PLUS. And as of Friday, this past Friday, September 8th, the closing price was $64.50, $64.50, with a 52-week price range of a low of $40.37 and a high of $75.90. The company does not pay dividends. The company is headquartered right here in my backyard, my neighbor, just a figure of speech, but right here in Herndon, Virginia. Next slide, please. Here's the executive team, a very robust executive team. Also, the board of directors is robust as well, but it's comprised of industry leaders with deep knowledge and expertise spanning decades. So if you look at the screen, you'll see the least is 25 plus years on this team. So they are very, very knowledgeable and experienced. They're guided by an independent BOD, a board of directors that have an extensive experience in sales, service, and financing. Next slide, please. Plus is taking it even a step further to deliver the best of the best and integrated solutions to help their customers achieve the best positive business outcome by strategically leveraging the technology of industry leading partners. You see here it's listed here that some of those you see listed here are some of the partners, and I'm sure some of them you know very well. Fortinet, Intel, NetApp, Cisco, Dell Technologies, and on VMware, Robot. So they're listed: Checkpoint, Hewlett Packard. Next slide, please. Not only their strategic partners, but their customer base is robust as well. Again, some of them you may know. ePlus believes their customer choose them for their complex IT infrastructure needs based on their track record of delivering best of breed and value add solutions from both the established and the emerging vendors we saw earlier on the previous slide. Their customer base spans across several industries, and you can see it at the bottom of the screen, the percentages where, just to give you an example, the most is at 20%, 26%, and that's in telecom, entertainment, and media, followed closely by technology with 20%. Next slide, please. So ePlus footprint spans both locally and globally, with 30 plus locations serving the U.S., UK, Europe, and Asia Pacific. They manage their managed services and integration centers strategically are placed throughout the U.S., and they are 24/7, 365 operations. And lastly, they are backed by more than 5,000 certifications and accreditations from the top IT manufacturers in the world. Next slide, please. Plus operations, okay, they're conducted through two segments. That's technology and financing. The technology segment derives revenues from sales of products, project-related advanced professional services, managed services, and staff augmentation. This segment sells primarily to corporate customers, state and local governments, and higher education institutions on a nationwide basis. It also provides internet-based business-to-business supply chain management solutions for information technology products. Now, the finance segment offers financing solutions to corporations, government entities, and also the educational institution nationwide and in Canada, the UK, and several other European countries. The financing segment derives revenues from leasing IT, medical equipment, other equipment, and the disposition of that equipment at the end of the lease. The financing segment also derives revenue from the financing of third-party software licenses, software insurance, maintenance, and other services. Next slide, please. Here I wanted to just display a few of the numbers. Again, you see in the upper left, a 30-plus year leading global technology integrator. They have over 4,300 customers serviced by over 1,700 employees. They have having over 1,000 OEM, original equipment manufacturer vending partnerships. Oh, and again, I mentioned the 5,000 certification and accreditations, and just some numbers at the bottom: 3.1 billion for the FY23 gross billings, and 2.1 billion for FY23 net sales. Next slide, please. So the BI methodology. So we'll jump into the core. So we're doing core. I'm kind of SSG core SSG. So the BI methodology tells us that we don't want to cross the barbed wire fence if some of our indicators aren't in place. So I'm hoping my indicators scream at you loud and clear. One of them is the consistent growth in earnings and share. This can be found under tab 1, which is the analyze growth. Step 3. This, in layman's term, is it going up straight and parallel? And I love to look at these numbers because they are. The lines are going up straight and parallel, green being sales and the blue being earnings. And then if you look at the numbers down at the bottom, just look from 13 on up, you'll see they are increasing steadily. And then if you look at the bubble in the graph in the quarter 1, 2023, sales as it relates to just 2022 sales has already increased. We're at 2184. So just wanted to kind of pull that out. Next slide, please. In core SS3, SSG, under the second tab is evaluate management. And I pulled out steps 1, 2, and 3. These indicators tell us the story about how well the executive team is performing. You have the percent pre-tax profit sales. We have 7.0 or 7.0 for that, and you see it should be going either increasing or at least staying steadily. This just helps us find out if, if the stock is becoming more profitable. I believe management is doing well there. It's definitely increasing, and if not, it's staying steady. Next is the ROE. Let your eye go more towards the numbers, more so than the zigzag line. It's not to scale. But if you look at the numbers, it's just the last 5 years, 18 through 22, 15, 14, 13, 16, 16. The average is 15.32. They teach us that ROE at 15 is good. It's not great, like if it was 20 and above, but it is good, and I like the fact that they're steady with it. So DTC, which is debt to capital, the percent to that. Again, take a peek at the numbers and see where they're steady there. It's steady decreasing. So this is the one we want to always see go down, if possible. It may be a little uptick, but it's usually a good reason. So we do have an uptick here in the quarter. So last quarter was 24.5, but the same period last year, SPLY was 24.2. So not a big uptick, just 1.2. In a difference, but again, that was due to acquisitions. So they do purchase acquisitions, but their debt is well handled, and they do have a nice amount of cash on hand. Next slide, please. All right, I didn't put it across the top. Oh, bad, Cynthia. So here, also in core SSG, the third tab, forecast sales and earnings, step 1, 2. And here I just kind of put it together to show you how I came about my forecast. Of course, I do my research. I saw a couple of the analysts, did some comparisons, pulled out averages. But one of the things, just kind of looking at this slide, what I did was just looked at the 10. If you look at, I'm going to start at the bottom. Sorry, I flipped it. But the bottom is sales. So if you look across the 10 years, you come up with the 7%, which is the growth rate there that they've listed. But also, if you were to take off the first 5 and just go with the last 5, the average growth rate would come out to be 10%. I do like the way that this is a medium-sized company, and they're growing steadily and they're increasing steadily. So I'm comfortable with the 5 being 10. So I'm going to go and I forecasted that 10%. When I looked at the analysts in the research, they were a little bit higher. So I'm comfortable with 10, just being a little conservative and going with what it says for the 5. They were a little higher, but again, 10 is where I am. And it projects to what we get to our forecasted low price, but we'll get there. And then up at the top is my EPS. Again, these are my projections. Definitely do your research. But again, I did look at the 15.3 across the 10 years, but I also looked at the percentage if I just did the 5 years. And the 5 years actually yielded about 18%. So again, being conservative, I went with 12% instead of going up, because I do like to keep my sales and my EPS pretty much the same, and then the lines, they're pretty projecting the same. So I wanted to stay with that. So I went with 12. If you look at the other pullouts, if you will, the historical high PE at 18.7, I went with that in the box for my 7.90 for my projected 12% estimated growth for the EPS, which gives me a high price of 147.7, and then down below percent here, it gave me a low for $49.10. So my high being for 147.70, and my low being 49.10. Next slide, please.
2 minutes,
And
Cynthia.
it shows on the thank you for our potential gain versus loss. My low being 49.10. 147.6 being high. The current price is now 64.50. It falls into the buy zone, giving me an upside downside ratio of 5.4 to 1. Again, to the right, it says it's in the buy zone, yielding a range projection up to the total return from 11.9 to 18.0%, with a closing price of 64. If you come down below, again, the projected analyzed price appreciation, 18%. No dividends, so you're not going to see a current yield or yield. Next slide, please. Here's just a synopsis of some of the kudos given to some of the companies they currently have in their base. They also get a lot of kudos and awards and accolades from their current strategic partners. Next slide, please. I want to just end with saying that there are ePlus is an advisor, strategist, designer, extra set of hands, trainer, problem solver, architect, and a great teammate. They are strategically and squarely positioned to forefront today's most transformable technologies, solutions, services, and finance expertise to help organizations imagine, implement, and achieve more from their technology. These are several of those services, just a few of the services I listed here. Next slide, please. And I'll conclude with saying this is a medium-sized, moderate growth company. They are well managed with a plethora of experience. It's, I would say, on sale, but I do like that the red bar being much lower than it would be. So I'm going to say it is definitely undervalued by investors, trading below its 5-year average high PE. Plus is a worthy candidate to consider adding to your portfolio, whether it be the watch list or a buy. And then Plus is a buy up to 73.40 to satisfy the 3-to-1 and the 15% total return. That's my story, and I'm sticking with it. Back to you, Kevin.
Thank you. Good job, as always. And now let's hear from Maskey, and he's going to look at the stock to study from this month. This is Crown Castle International. And take it away, Maskey.
Thank you, Kevin. Good evening, everyone. I'm Maskey, member of the Model Investment Club of Northern Virginia. I found this company using my stock prospector software. This is an interesting company for most income-oriented investors. It is a part of the wireless working industry, leasing land for companies to build domestic cell towers for large companies like AT&T, Verizon, T-Mobile, and US Sprint. Next slide, please. Crown Castle International Corporation operates as a REIT, is a domestic owner and operator of cell towers. About 74% of 2022 site rental revenues are derived from AT&T, Verizon, T-Mobile, and the US Sprint. It acquired other companies like Mountain Union Telecom in July 2006, Global Signal on January 2007, New Path Networks in September 2010, Australian subsidiary, and Quanta Fiber Networks in 2015. Next slide, please. Crown Castle at a glance, the dividend per share has grown to 6.4% as of the last value line, which demonstrates their ability and resources to grow the dividend, and their annual compounded average growth rate is 9% over the last 7 years. This demonstrates their mission to focus execution to drive value, leading to disciplined capital allocation, resulting in a strong balance sheet. Next slide, please. It pays an attractive dividend yield of greater than 5%, and it is supported by high quality, long-term contracted lease payments that result in long-term growth tailwinds, result in forecasted dividend growth target of 7 to 8% in the outer years with double-digit total return opportunity. Next slide, please. The diverse offering of towers, small cells, and fiber solutions uniquely positions Crown Castle to capitalize on 5G deployment, supporting our long-term annual dividend and total return. As of 12/31/22, it owned and operated approximately 40,000 towers and 85,000 route miles of fiber in the US and Puerto Rico. Next slide, please. It has greater than 40,000 towers, provide critical information for coverage and capacity, and approximately 120,000 small cells that enable additional network densification by offloading traffic and bolstering capacity in the areas of network where data demand is the greatest. And approximately 85,000 route miles of fiber optics that increase returns on fiber investments by sharing the same fiber assets across thousands of fiber solutions to customers. Next slide, please. While Morningstar has given CCI 4 stars, it believes that greater growth is from the towers part of the company. From Value Line, the lease cancellations that are related to T-Mobile and Sprint network consolidation will anticipate 2023 full year revenue growth to be minimal. However, as cell phone usage increases, wireless data demand increases, and this leads to a higher tenancy on Crown Castle's towers. Furthermore, the company's master lease agreements provide an opportunity to drive new business growth and increase tower activity over the next 3 to 5 years. The shares of Crown Castle offer an above average price appreciation potential over the 18-month and also out to 3 to 5 year timeframes. It has a financial strength of A rating and a safety rating of 2, which is above average, and this aligns well with the consistent dividend growth and above average dividend yield. The price stability score of 85 out of 100 enhances the company profile. Next slide, please. This graph demonstrates that sales and earnings per share will be minimal in the years 2023 and 2024. But we'll go back towards the trend line by 2028. Also, the gap between the sales and the pre-tax profit line is narrowing, which indicates that the Crown Castle is controlling and lessening their expenses. Next slide, please. The pre-tax profit on sales for the past 5 years is 17.8%, and the return on equity to shareholders is around 11.4%, both within the good ranges for a well-managed company. With historical sales of 9.5%, Crown Castle over the past 5 years has kept up with its peers, with the exception of American Towers at 12.7% and Equinox at 15.2%. But however, in the most recent quarter, Crown Castle is at 7.7%, has moved ahead of American Towers and is closing in on Equinox. Next slide, please. According to the first SSG graph, 2023 and 2024 will remain at minimum levels. The growth will remain at minimum levels, and the growth will have a greater growth in the outer years. Based on this information, I kept my sales growth at 3%. Next, I have to go to the next slide. According to the SSG graph, 2023 and 2024, the growth will be at minimum levels, and the trend will go up in the outer years. Based on this information, I kept my sales at a minimum of 3%. And this results in a 5-year projected sales of $8.3 billion. Next slide. I took the value lines estimated percentage of 7%, which is also equal to the earnings per share change from a year ago this quarter. Also, with the earnings line closing in on the gap between sales and pre-tax profits, which demonstrates that CCI is reducing their costs, which will result in higher earnings. The 7% estimated growth rate will result in a 5-year projected EPS of 5.53. Next slide, please. The percentage of debt to capital is declining compared to American towers, but slightly higher than the industry average for the last 5 years. And this was due to the growth by its acquisitions of other companies. Next slide. CCI has managed to bring down both their high and low PEs to a current 12 trailing months of 45.2 and 24.9, with a current PE at 25.3 and average PE at 57.4. They are significantly undervalued. Next slide, please. I chose a lower average high PE of 35 due to the decreasing PE trend that resulted in a high price of 193.60 and a low PE of 25 to come out with a low price of $98.50 and a final low price of $70, which comes out to be 70% of the current price. I just gave this a buffer in case there's a market drop down of 30% that may result, in the current due to any national or global events. Next slide. The closing price as of 8/24/23 was $99.50. It has an upside downside ratio of 3.2 to 1. 94.5. It has also a 94.5% potential price appreciation. The upside downside ratio of 3 to 1 and a 15% total return if it is bought below $100.90. Next slide. This graph shows the upside downside ratio. Within the zones, CCI at its current price is near the top of the buy zone. Next slide. My conclusion is that CCI is a medium-sized with moderate sales and earnings per share growth. It is a well-managed company with the higher levels of debt due to its growth by acquisitions. It is trading below the buy range. It is a worthy candidate for those that want to add a REIT to their portfolio. It is a buy up to $100.90. The buy price to satisfy upside downside ratio of 3 to 1 and a 15% total return. That's all I have, folks. Thank you.
Thank you, Maskey. Very nicely. So we've done the two on core, and now we're going to go over to plus. And the first one out of plus will be Medpace Holdings and Ty Hughes. Go ahead, Ty.
Thanks, Kevin. This is an interesting company. By the way, I'm a member of the Model Investment Club there for Northern Virginia. Also have a Friends and Family Club that we've been operating for about 22 years. But let's talk about Medpace Holding. It's a clinical contract research organization. They call them CROs. And identified that. It popped up on some screens. It's on the roster of quality. It's an interesting company and I think a very decent, potentially core holding. Next slide, please. So what are these clinical studies? This is a graph from NIH that I found, and you can see the amount of growth here in clinical studies. You have to do a clinical study before certain drugs are approved, certain medical devices are approved. The global CRO market is about $60 billion in 2022, and it's been growing steadily at 12% a year and is expected to continue through 2030. And this demand is driven by pharmacological developers. They want to enhance management of clinical data, and also it's very complicated to get through the regulatory process. So these CROs specialize in working the regulatory side, while the scientists and the principal investigators can do their work. Next slide, please. The demand for this is global, although I will say, after researching, Medpace has global reach, but probably 98% of its work is done in the United States. Next slide, please. This is a clinical trial process. Some of you may be familiar with this, but you've got to work through the 3 phases before you can bring a new drug or a new medical device to market. The first phase is where they look at safety and dosage. The second phase is where a small number of people enroll for the clinical trial. If that's successful, they move on to the third phase, and if that's successful, they move to market. It is very expensive to bring a new drug to market these days. Estimates $2.5 billion is not uncommon, and it can take up to 10 years to work through all of the phases of the clinical trial process in order to get approval. Medpace, their niche is small and medium-sized companies. A lot of the big pharmaceuticals do some of this in-house. They've got sophisticated staffs, but Medpace has made its market out of smaller companies that are trying to bring something to the FDA for approval to bring it to market. Next slide, please. This is a definition of a contract research organization. I won't read it to you, but this is basically what they do. It's a fairly fragmented market. Next slide, please. It's interesting. Medpace is the smallest of it. It always pops up in the top 10. If you Google top 10 CROs, Medpace is almost always in there. But interestingly, they're one of the smallest in terms of revenue. This is 2021. I didn't update it for later years, but it gives you some idea that they're a solid player, but they're also small, which has, I think, from our perspective, a lot of advantages. Laboratory Corp of America, Icon, Syneos Health, PPD, which is now part of Thermo Fisher Scientific, and IQVIA are some of the big players in this. Next page, please. So here's some statistics from some of their marketing literature. You can read that yourself, give you some idea. They've been doing this for 30 years. They're a really solid company. And as I'll mention later, the founder is still runs the company. He's still the CEO. They have a great business model. If you're looking for a simple, straightforward business model for an investment, this is it. They're very well regarded, a lot of expertise, and a lot of years of experience, and kind of a single market, the CRO market. Next slide, please. Here's just a couple. I'm going to show you 2 slides of just how they describe themselves. Interestingly, their main segment is oncology. About 30% of their sales comes from oncological testing. And this is a pretty big market. This is about 30% of the clinical trials that are listed worldwide are in this same space. And this company is particularly good at it. They're considered to be very expert. And that if you look at their revenue against the total addressable market, I told you it was $60 billion last year. They're 0.2% of that addressable market for oncological services. Next slide, please. Just some more information. That last one, everything I've read about them, they're really solid from a knowledge and expertise perspective. Next slide, please. These are just some of the trends. You can see they've they've continued to grow the company, and importantly, they do it organically. They're not into acquisitions. A lot of the big companies have grown through acquisitions, and at some point that peters out. But they are still growing organically just based on their reputation and expertise. The way revenue is generated in this market, the contract for services, there's a duration and pricing. It's generally a fixed fee, and then it takes into account the different services which are going to be performed. The contracts can vary in duration from a few months to several years, and they're negotiated based on the project scope and the complexity and the inherent performance risks. They're typically structured with an initial fee due at contract signing, with the remaining fee paid over the contract's duration. The advantage of this type of arrangement is that once they're in, they're probably, unless they have a problem, they're in for the duration. And so once they book the initial business, unless the research ends, they're going to be generating revenue from that throughout the whole period of the clinical trial. Next slide, please. Just another. This is just net income. Their net income tracks pretty closely to their revenue. Next slide, please. And when we look quarter by quarter, we see pretty steady growth. A couple of bumps there, but the revenue is solid, and sequentially quarter over quarter is growing. Next slide, please. I looked at some of the peers on that, and you can see their curve. The Medpace is that black one on the bottom, and it's a little bit steeper than the other, which is good. Solid revenue growth. They're doing probably better than their peers. Next slide, please. This is their margins. They're up there really solid. IDXX has slightly better margins, but they're second out of the four on this slide. Next slide, please. This is a slide I really like. I put pre-tax profit on here too, and I also very conservatively used 15% forecast for revenue and earnings. Could have probably done 18 and it would have been fine, but I like to do these in a conservative way. And then those are the Morningstar projections there on the out years for 2023, 24, 25. Next slide, please. Something else I think is very important to look at when you're doing these SSGs, there's an opportunity to look at the quarterly data. So I've looked at the trailing 4 quarters. I look at pre-tax profit rather than earnings. And you can see there's 2 lines there. The bottom line is the 0 line, and then the other one is the what I've used for the earnings growth, 15%. So you can see that both pre-tax profit and revenues are growing above the 15%, which is good. Next slide, please. Quality's good. All the metrics are good. Couple things about the founder of the company. Let me just find my notes here. August James Trundle is the founder. He still serves as CAO. He's got extensive knowledge of the CRO process and biopharmaceutical industries. Prior to founding Medpace in 1987, he served as an assistant director for Sandoz, which was Novartis. He owns 21% of the company, which is almost $2 billion in value. So he's got a lot of skin in this game. His base salary is only $700,000, which is a fraction compared to what his peers on those other big public companies are getting. So I just thought I'd mention that. They're in Cincinnati, Ohio, and I think there's sort of a special chemistry there. They're a little bit of a, middle America, Midtown. There's a lot of, as you know, a lot of medical communities there in Cincinnati, and he's been the founder, and this is his company, his baby, and he's got a lot of skin in the game. So I think that's all good. Next paragraph, next slide, please. PE history, because it's a steady grower, the PE tends to run a little higher. You can see here the high and low PE lines. They've been pretty much straight though, so at 2018 forward. They really haven't deviated too much. They went up a little bit in 2021. Next paragraph. Next paragraph, next slide. So here's where we are. When I first identified this stock, it was a screaming buy. It's gone up a bit. I'll show you a price chart here in a little bit, but It's very close to being a buy. If you want to insure 3-to-1 and 15%, you're going to need for it to come down a little bit to guarantee that. It wouldn't be a bad stock to jump in now, but I think I would wait until there's a little price correction. Next slide, please. This is high return. I projected about 12%. If I had used a higher sales number than 18 say or so, it would be up closer to 15%. So this is a very conservative projection. Next slide, please. Value Line, they kind of think it's as well that it's still a solid company. They think it had a run, which is correct. It has. This is how they assess it. Good financials, B++. Very little debt there, $55 million in debt, so debt's not even an issue for this company. Next slide, please. So here's a price chart. You know, back in and I did buy some of this from one of our clubs back in July. It's had a bit of a run up, but as you can see, when you go back, it's not uncommon to see a correction, 5 to 8%, maybe 10% correction from time to time. So if this company interests you, I would wait for a pullback and grab it. It's definitely a core holding. They're in a long-term market. They've got a great business model. They're a solid company. All the indicators are very positive. Next slide, please. This is my summary. Moderate growth, well managed. It's fully priced right now. Definitely put it on your watch list, and I would buy it anytime it gets down around 250. I would consider buying it. Next slide.
Very good. Thank you, Ty. Great presentation. And last but certainly not least, we have Susan Tano, and she's going to be able to tell us about the undervalued feature from this month, and that's Kinder Morgan. Take it away, Susan.
Well, good afternoon, everyone. Tonight I'm presenting Kinder Morgan. It is the BI undervalued feature for September this month, and it is one of the largest energy infrastructure companies in North America. Next slide. Kinder Morgan, along with a couple other companies, they are what is considered midstream companies. These are the types of companies that provide infrastructure to have the product that they move from the vendor to the consumer. The vendors could be things like Chevron, Exxon, ConocoPhillips, and they provide crude, and the midstream companies move that product to the end user. They're usually third-party service providers that sits between the producers and the end users, and they usually operate things like pipelines. So you will see companies like Kinder Morgan, they're usually called Master Limited Partnerships, or MLPs. Next slide. Kinder Morgan is one of the oldest and the largest domestic corporation that transport, stores, and treat things like crude. Their main business is handling natural gas, both pressurized and in the liquefied form. And as I indicated, they also move crude oil and refined petroleum products. One thing I found out is they also move carbon dioxide gas injected in oil fields to increase production. So that was very interesting. I didn't think they were in that space, but I'm learning more and more. Next slide. For the history of this company, it started way in 1997, and till today they have gone through several iterations. They started as a publicly traded company, they went private, they came back public, they went into, and then they got into the MLP space in terms of being a master limited partnership. They bought out a lot of their the initial units in their company. They grow by acquisitions. So it is an area that is very, very complex, and it's one of the things I'm still learning about. Okay, they company owns interest in or operates about 82,000 miles of pipelines, 140 terminals across North America and several other, you know, countries. So it's that's a lot of pipeline. Next slide. What is Kinder Morgan? It has a very complex business environment, and they typically provide K1s to their investors. They are economically sensitive. Lots of things create problems for them. Shifts in economically sensitive prices affect transmission. Things like fires, cold, heat affect a lot of what they do, because they sometimes have to shut down in the area, like a large forest fire, and these pipelines go through a lot of forests. They try to stay away from a lot of the urban areas. So there's forest fires. Sometimes they have to shut down that pipeline until the fire is contained. That affects, you know, their production, but it also affects their bottom line depending on how long they need to have these pipelines shut down. Next slide. Current events. Recently, Kinder Morgan recorded weaker second quarter results, which impacted their bottom line, but it also impacted their stock price. They were notably hurt by a decline in the commodity prices. And if you go back a couple of years to the start of the pandemic, you will notice that the price, when the price of crude dropped like a rock, this really hurt Kinder Morgan. As the market reopened, as the economy reopened, the prices recovered very rapidly, and so did the price of Kinder Morgan stock. Recently, this company has been trading in a very tight price range between the price points of $14 and $21. Next slide. Value Line seems to like the company a lot. Reading the current value line, they think that interest expenses are poised to climb, okay, but they have something that Value Line seems to like, which is that they are a key supplier to the U.S. power plants, which are increasingly using natural gas to back up greener energy sources, okay. They're thinking that this company should be paying down debt, which is going to offset the higher interest rates. One of the drawbacks to being an MLP is that they have to pay out a lot of their earnings as dividends, and so they're always in the debt market trying to recycle money, because as they pay out a lot of their earnings, the current earnings as dividends, or how should I forgot the name they used to call it. Sometimes it's a return on capital, sometimes it's other things. They go back to the debt market either to sell more shares or to, you know, create other debt products so that they can get more money to do what they currently do. Value Line expects that earnings will advance to $1.35 per share in 2024 and to between 2026 and 2028, it should get up close to $1.70 per share. Next slide. Here is a peer comparison. When I looked at the full 10-year picture for Kinder Morgan, they were essentially close to being very flat. They were looking at a range of 1 to 2% growth in revenues. But over the last, say, 5 years or so, they have been, as I indicated here, they're growing about 8%. I have looked at, for the comparison, I've looked at things like MPLX and a couple of other products that right now Kinder Morgan there's one that's growing a little bit faster, but Kinder Morgan has been consistently just plugging along. Next slide.
5 minutes, Susan.
Thank you. So here's the peer comparison for earnings. As you can see, as I indicated, it's economically sensitive, it is financially sensitive. So you see, as with all of them, there is a lot of herky-jerky movements in the earnings. Next slide. Here's the visual analysis of the company at a glance. I use SSG Plus instead of Core. And as you can see, again, you're seeing that sensitivity in the product, in the movement of the stock. And the most recent year, you can see that the price bar is very, very tight, and it's currently sitting at the bottom of the price bar. Okay, looking from what I looked at for the 10-year history, I used a forecast of 1% growth for revenues and a 2% growth for earnings. Next slide. As with TIE, I looked at the quarterly data trailing 4 quarters, and you can see that it is fairly flat in the growth of a lot of the revenues of this company and the earnings. Next slide. Looking at section 2, you can see that pre-tax profit looks pretty good, and so does percent return on equity. Debt to capital is fairly high, but they look like they're trying to pay down debt, and that's one of the things that Value Line recommends that we should be looking at. Here is some of the issues that affected this. In August 2021, the explosion of one of the Arizona pipelines reduced the natural gas supplies to Southern California, and this extended for more than a year. The PE to projected growth, Yahoo reported a 4.0 for Kinder Morgan based on the annualized 5-year expected earnings. So because of these herky-jerky movements of the stock price as well as the earnings, you see a lot of outliers when you look at the SSG, especially on section 2. Next slide. Here is the PE history. You see spikes and then it goes almost flat. So it makes it a little bit difficult to decide what you are looking for. The average PE ratio was about 20, whereas the current is 15, which indicates an undervaluation. Next slide. Looking at the section 4, evaluating risk and reward, my forecasted high price was 28 and my low price was about 13. The current price, as I indicated, is in a kind of been trading in a range for the last 6 months or more, is about 16.8, with an upside downside ratio of 3 to 7.1. And as you can see from our beautiful pictorial, it's sitting just in the green zone, just right below the top of the buy zone. Next slide. Here's my 5-year price potential. It indicates that it is in a good position. If you believe that this stock will do as intended, it pays a great dividend as a master limited partnership. But be aware that as the earnings goes, so does the dividend. So that is something that you need to be quite aware of, because if the earnings drop for a sustained period of time, the dividend will also drop. It is still a function of earnings, but you can't pay what you don't have. So there is going to be some erraticity in the dividend payment as with the earnings. They have been fairly consistent about paying out a good 5% or more of the dividend over the last couple of years, but because the price of what they move has increased back through the pandemic. Next slide. Here's value line information. You can see the annual rates and what Value Line thinks about it. The company's financial strength is not as good as some of the other companies we heard at today, and its capital structure shows that, where their money goes. They have total debt of over 31 billion. Okay, debt due in 5 years is 12.8. Okay, long-term debt and long-term interest payments. These are things. They also have a lot of pension assets and leases that are uncapitalized. There is no preferred stock, but you need to know, where their money is going. Currently, their shares are ranked as a 4 in the Value Line system, but Value Line still seems to like them very, very much. If you're looking at the income tax rate, it looks like it's fairly stable for the last several years and projected future years, along with its net profit margin. So on the whole, it's a company that Value Line thinks you would be able to make money with, but you need to be aware of the risks going forward. Next slide. Here's the daily price chart, and as I indicated, you can see that the stock has been trading in a very narrow range for a couple of months or more, and you can make your own decision as to where you think it's going to go from here. Next slide. And as you can see, PMI is a large size, slow growth company. It is well managed, and based on the information that I was able to glean, it is currently undervalued underneath the average PE that the company normally trades at. The dividend has been increasing annually over the past 6 years, with it recovering since 2016. The quarterly dividend recently climbed 3.4% to 30 cents for an annualized level of $1.20. It is currently in the buy zone, but again, if you are aware of the risks and you're growing, you want a company that pays a decent dividend for the price of the company, then this is a company to consider. And that is my presentation for tonight. Thank you.
Thank you, Susan. Very nice. Okay, we went through these pretty quickly. So what we like to do next is we like to go back and ask all of our presenters where it sort of fits on what's called the life cycle. And if we go to the next slide, Cheryl, this is the T. Rowe Price life cycle. And what we're going to do is we'll ask each of the presenters, and we'll start with Cynthia. Tell us why you picked that location for ePlus.
I picked this location right between explosive growth and mature, because of today's times. Right now, with the talk of emerging AI, companies looking to still have people work from home, this industry is competitive. It's a lot out there. However, this company, with the experience they have and the hunger for innovation and to keep growing, puts them still in that explosive growth where they're going to continue to grow. And you see their history where it's year over year increasing, and it isn't anything slowing down. So because of those reasons, I left them in explosive growth. And because of their 30-year in existence, I put them close to mature growth because they have been around for a while, but they are still explosive and they are still taking advantage of today's atmosphere, if you will.
Okay, thank you. And now Maskey would be doing CCI, but he had to leave, but he was working with Cheryl on this one. So Cheryl, can you give us why Maskey and you selected that location for CCI?
Basically, CCI has also been around for a while, but because a lot of their growth has been through acquisitions, they're constantly adding in companies that kind of push back the line from mature growth. And so that is why we kind of picked in between explosive and mature growth.
And Ty, you want to tell us why you picked that location for Medpace?
Yeah, sure. Similar to Plus, it's Medpace has been around for about 30 years. They're well established. And as you can see from the charts, their revenue growth and earnings growth have been pretty stable, but fairly high, close to 20% for a long time. So I think they're not they've not reached the point of saturation. They're one of the smaller players in that market, and I think have a lot of room for growth. So I put them just on the other side of the explosive growth demarcation point.
Thank you very much. And last, Susan, tell us why you got that location for Kinder Morgan.
I chose that location for Kinder Morgan, one, because of the space that it's in, and also because this company is growing by acquisition, but it has a dilutive effect as well because of the company structure. So it's always going to the market for new, fresh money. It's not a company that's going to grow very, very, very fast, but it should provide some stability to your portfolio. It's also a company that you are probably going to provide lean on more heavily to provide a dividend stream rather than a growth stream. You're not going to get great capital gains from this company, but you will get great dividends and dividend growth from this company. So that's one of the reasons I think it's right now straddling more between mature growth and stabilization or possible decline. It's going to be interesting to see how the company management navigates that. But as with most of the other companies that we spoke about here tonight, it's been a company that's been in existence for a great number of years, and they've been managing that tightrope fairly well.
Okay, thank you. And let's go on. We're just about, I think we're ready to have our people vote. If we go to our next slide. So, Cheryl, if you can release the poll, we've been doing all the chatting. Now it's a time for you to be able to vote on which one you think is the most interesting, the one you'd want to do the more research on. It's not necessarily the one you want to make a buy of, but from the presentation, which one you find kind of intriguing, and take a look at that. It's free. You can be able to do this. We've got a few people voting here. Let's see if we can get a few more. People are starting to come on in here. Let's see if we can get, all right, we're over 50%. Can we get up over 60% participation? We did. Now I'm going to be like an auctioneer. Let's see if we can get over 70. Okay, can we get over 70%? We're just about there. We are. One more. Let's see if we can get a few more people to come on in. I'm going to sort of think in my head. Cheryl, it looks like it's staying stable, so go ahead and close it. And share that with everyone. So there it is. The winner tonight's by a mile, Medpace Holdings. Thank you all for participating. We can keep this up for a moment. Jonathan, are there any questions for our presenters today that we can do? I know you've been taking care of a lot of those questions there.
Yes, I have. The presenters did a fantastic job. No questions currently.
Okay. If anyone wants to ask some questions, go ahead and raise your hand, and we can open up your microphone to do that. You know, anything that sort of strikes your mind on these stocks would be good to do it. Anything? It looks like, yeah. It looks like no one is really responding. Okay, we'll tell you what, we'll go through a few more slides. We're just about done, and we want to get done probably about 8:30. But if you have any additional questions, here's how you can reach us at the DC chapter and the Maryland chapter, and also specifically for this webinar, there's the Digging into the BI contact. There's a picture of many of us, not all of us, at the last in-person Bink in Dallas in, what was that, 2022? Okay, I had to stop and think. Anyway, so there's where you can reach us if you have any other additional questions. Next slide, please. Again, if you want to be able to be on our mailing list, and I see a lot of people in the audience are, but just come here to the DC chapter. We won't inundate you. You'll get this. You'll get stuff for the book club and for educational events. Most of them, almost all of them are free, and a lot of them are going online, so you can do that. And this, of course, will always be online. So please do that. Next slide. Jonathan, you want to tell us all about why you should volunteer?
Sure. Volunteering is a fantastic experience, and you're really working and learning and helping like-minded people. So it is a wonderful experience, and everyone is encouraged. Better Investing is a small community, and it takes a village. It takes a village to educate one another. And so the more people that we have helping and educating and our community, we're just much better off. So definitely consider helping and volunteering. And there are many, many benefits that you can read on the slide here. So take advantage of this opportunity. Thanks.
Thank you. Let's go to our next slide, Cheryl. And so here's the stuff that's coming up for next month. We have Danaher as a stock to study, and Alphabet is the undervalued feature. And I actually have a hole. I need someone to be able to help give us a fourth presenter for there. That would be really great. If any of you in the audience want to do it, please put a notice in there or raise your hand. We will certainly help and work with you. No one is expecting this to be a perfect presentation, but this is sort of how you learn and become a better investor yourself. So we will give you the resources and give you maybe a mentor to help out with it. We'd love to have you be a part of this. That's how this community works. You'll learn a lot more the more you actually do presentations yourself. So there's a little bit more of a commercial announcement. But keep that in mind. We'll be on October 2nd. And let's go to our next slide. We also have stuff up on Manifest for those people that are over there. You don't even have to be a Manifest subscriber to take a look at this. You can see all the different ways that these dashboards are put together. And again, if you download, no, you can go to that next slide. You can go to slide 111. And up here, you can be able to see over on the right-hand side, those are all hyperlinks. You can click on them, and you can be able to go straight to that dashboard to be able to see how it's performed and give you an idea of how it's going. And that's really it. You don't have to even be a member or a subscriber of Manifest. Next slide. And also it'll be up on YouTube, hopefully later on tonight, if I can get around to it. There's the link to it. Thanks for coming. Come see us next month, October 2nd, when we will again be digging into the BI. Last call, Jonathan, any questions or did we get them all?
Looks like we got them all.
Okay, thank you all for coming. Thank you to all our presenters. You did a great job. Glad to have you all with us, and we'll see you next month. Good night, all.
Good night.
Good night. Thank you.